and how much he has to pay taxes. This has to be known to the person concerned. As an individual, you must know how much you have to pay taxes, on what amount you have to start paying taxes, and when you have to pay taxes. If you do not know, it is not arbitrary and it is not certain. So the canon is actually ensuring the certainty of payment of the taxes. So you can make a plan that I will be earning 4 lakhs taka per year, and out of that 4 lakh taka, I have to pay taxes at a certain rate. You know the rate, at least you know the rate of the current year, and you have to make a provision that I have to pay taxes to the government this much amount of money, and the payment has to be made in 4 installments. When you go into details of the income tax ordinance, we will understand when we have to make the payment of, taxes. That means in advance tax. Advance tax has to be paid by the individuals or companies or corporations, and how much you have to pay, in how many installments we have to pay. So that's why that is understandable to us. So it means that it is a principle of certainty for the taxpayers. Okay. And at the same time, government also knows how much money it will be collecting from the people or from corporations or companies. So there is a growth and there is a target. So say, for example, if money is collected, tax is collected at the rate of 40% on the companies, so how much money has been collected this year? And on this basis, what would be the probable collection from the companies in the next year? It is possible to understand. And if the government actually increases the rate of tax, say from 40% to 45%, then there would be a 5% growth on the income from the companies. And if there are, additions of the companies to the list, definitely the income will also increase. So in that way, the budget is actually prepared and an estimate is made. Then you go for another canon, which is called canon of convenience. So every tax has to be levied at the time or in the manner which it is most likely to be convenient to pay it. It means that if I impose the tax on a person at a time when he is not actually ready to pay the taxes, or it is not convenient for him to pay the taxes, it will be difficult for him to comply with the government directives. Generally, there is an accounting year or there is an income year of the, so they maintain their accounts. Say, for example, from January to December, if it is an accounting year, at the end of December, they will prepare, trading account. So the businessman will be able to understand how much income he has earned during the year. And afterwards, what would be the net profit of the business he has arrived at. So on the net profit of the business, he has to pay taxes. So it is always better to impose tax or ask him to pay taxes after he has completed his accounts. And say, for example, when local taxes are collected by the government, say in the rural areas, the tax is collected by the Union Parishad, Union Parishad, and that is a local authority. And local authority collects taxes when the harvest is actually completed. That means when the farmers finalizes the harvest, that means they are getting the crops from the fields, and then they can sell out their crops, and afterwards they are ready to pay taxes to the local authorities. So the time is actually after the harvest. So there is the principle of convenience, and Like that, everybody has to pay taxes at his or her convenience or at its convenience. Then you come to the point, canon of economy. The cost of collection should be as small as possible. If the bulk of tax is spent on its collection, it will be it will take out much out of people's pockets, but brings very little into the state's pocket. It means that if we spend more money on collection of taxes, so there will be a lot of expenditure from the collected tax. So if a lot of expenditure is there from the collected taxes, there will be little to be saved in the pocket of exchequer. So which is not actually expected. So what should we do then? We should be pursuing a principle by which we can collect taxes, spending a little money. That means the administration should not be very, large, and too many people should not be engaged in collecting taxes, but rather there should be a policy by which people would be encouraged to pay taxes automatically. That means you have heard about that deduction of tax at source. It means that when you are working with an organization, the accountant or the finance officer or the chief finance officer or the director of finance would be responsible for deducting taxes at your source. At your source means you are being paid the salary each month, and when paying salary to you, they will deduct a certain percentage as advance tax. And at the end of the year, you will be given a certificate that so much tax has been deducted from your salary, and that will be credited in your account in the taxes department. That means where you are paying taxes. You are paying taxes in a circle. That means you are an assessee or a taxpayer of a particular circle to be administered by a deputy commissioner of taxes. So it will go to your credit. You will be given the credit while he will make the assessment. So it is easy for you that you are not paying taxes at the end of the year at a time. Rather, your direct tax, that is tax at source, is being deducted. So you are not actually getting pain of making the payment at a time. So that is the way how the system should run. And these are the principles actually introduced by Mr. Adam Smith. So that's why Adam Smith is called the father of taxation. And these are the four principles on which other principles are actually introduced later on. Economists have introduced other principles. So what are the other principles? When you say that the principles introduced by Mr. Adam Smith, you will write four principles. And if you are asked to write principles of a good taxation system, then you will write the principles of Adam Smith and also the principles of Mr. Smith. So that would be a combination of all the principles introduced by various economists, including the first one, that is Adam Smith. And the principles introduced by Adam Smith, sometimes called Smithian canons. Smithian canons. So you have to learn this word, Smithian canons. If I ask you, what are the Smithian canons? You should not pose such an appearance that it is Greek to you. You must answer the question in a bold way, and that is Smithian principles means these are the principles introduced by Adam Smith. Okay, then apart from the Smithian canons, we would like to go for other principles like canon of productivity. A tax should bring in a substantial amount of money to the state exchequer. Productivity means it should be productive, and it should be a substantial amount to bring to the national exchequer, because exchequer, there should be a growth in the collection of taxes. So tax should be such that, or it should be imposed in such a way so that there would be a very good growth in the national exchequer. Canon of elasticity. It means that our tax should automatically bring in more revenue as the country's population or income increases. It means it should be like that. When the income increases of the people, when there are more businessmen in the country, or the income of should increase, and when the income increases, definitely tax will also increase. So if somebody works in an organization, he will pay taxes. When somebody does business in the country, he will also pay taxes. So in that way, when the population increases or the income increases, definitely they will pay more taxes. And that is the theory. That means elasticity. When rate of taxes will increase, there will be a tax, which is called elastic tax. So this is elastic tax. Of simplicity. That means taxation system of a country should be simple. Otherwise, there would be confusion and even corruption. The SSC has to go to the lawyer, and the lawyer may take advantage of the complication. Even the assessing officer may take advantage of the complications. It means that if the income tax law is hard, it is complicated, then people means the lawyers, the income tax practitioners, the advocates, the chartered accountants, the cost accountants, etc., they will take advantage of that complicated system, etc., because the assessees or the taxpayers, they will not be able to understand what a tax means, what are the systems or procedures of payment of taxes, how to actually submit the return of income, and how to fill in the form, and how much would be the calculated tax as per the rates of tax introduced for the assessment year. So that's why the tax system should be as simple as possible so that people would be able to understand that. If the people, that is the assessees, do not understand the system, they will definitely go to the lawyers or the advocates or the chartered accountants, and they can take advantage of their ignorance. And even the assessing officers, assessing officer means you will be able to know who are the assessing officers. Assessing officers are generally called deputy commissioners of taxes, and the deputy commissioner of taxes has the pivotal role in the assessment of the income of the people. So if taxpayers do not know much about the taxation system, the deputy commissioners can take advantage of that complication as well. So it is always difficult for the assessees. That's why there should be a canon of simplicity. So if we understand that taxation system in a country is simple, it means that it goes in favor of the assessees. Then I come to the point, canon of variety. The canon of variety means the tax system should be diversified. It means that reliance on a just few taxes is always risky. If I just stick to income tax on business people, this is not actually very easy for the government to realize taxes. There should be a variety of taxes, and if there is a variety of taxes, it is less vulnerable. Otherwise, it will be more vulnerable. So if the system is risky, government is very likely to get less amount of money as taxes. So that's why there should be a wide coverage of taxes, Taxes means wide coverage of taxes on various income. So there should be various incomes to be considered into the spectrum of imposition of taxes. That means I have to impose taxes on income of business. I have to impose taxes on income of services. I have to impose taxes on income of salaries. I have to impose taxes on income of, say, capital gains, or I have to impose income on earnings from lotteries, etc., etc., etc. So that's why there should be a wide variety of, taxes the government would impose. Then canon of flexibilities. That means flexibility connotes the absence of rigidity in the tax system. There should not be any rigidity in the tax system. It means that there should be some sort of flexibility. A flexible tax system quickly adjusts to the new conditions. It means that what is a flexible system? Flexible system means the system which can easily adjust to the new conditions. So if there is a new condition, the system would automatically adjust to that. Elasticity means income can be increased, whereas presence of flexibility is a precondition for elasticity. We have discussed about elasticity. So elasticity means income can be increased. So if income can be increased, tax can be increased. But the presence of flexibility is a precondition for elasticity. If there is no flexibility, there is no elasticity. If there is flexibility, there is elasticity. So these two terms are actually interdependent. So that's why we have to go for that canon of flexibility. Okay. You know that I have mentioned in my handout that there is an import duty in the country nowadays. Of course, you know that. And earlier, import duty was very high. Even 500%, 700% in import duty was there. But nowadays, import duty is not that high because it has been reduced to 25% only. Maximum import duty is 25%. It cannot be more than 25%. But you can say that the duty is sometimes very high. We do not understand how it is actually imposed. Yes, that is true, but that is not import duty. That is other duties like supplementary duty, etc. So why supplementary duty is imposed apart from the import duty? Because it is the compliance of the World Trade Organization. World Trade Organization actually controls the business of all the countries of the world. So we are a member of the World Trade Organization, and that's why we have to follow their principles, the restrictions or the bindings. So we cannot raise our revenue more than 25%, but the prescription of the World Trade is that it has to be reduced to zero in future. So when it will be reduced to zero, it means that we cannot earn any income from import duty. There is no tax as import duty. It is an indirect tax, of course, but we cannot collect import duty. So when we would be unable to collect import duty from the importers, what should we do? We have to impose other taxes on, income tax, corporate tax, etc. That means on direct taxes. So that's why there is a precaution that we have to adopt in order to retain the collection what we are making now. We cannot reduce it because of the government's dependence on the revenue. And you understand that the share of tax in the GDP nowadays is 9.3% only. So this is not actually very high. It's very low compared to other countries of the world. And we have to raise the revenue in terms of taxes. So would you like to have a break now or afterwards? Hello?
Yes, sir.
Would you like to take a break now or not?
Yes, sir.
Okay, sir.
Yes, sir.
Okay.
Hey.
Yes, sir. Thank you, sir.
Yes, sir.
for how many minutes?
জি স্যার, আমরা একটু ব্রেক নিতে পারি স্যার।
15 minutes, sir.
Sorry,
Sir, 15
স্যার
minutes.
15 মিনিট আমরা স্যার ব্রেক নিতে পারি।
15 minutes. Okay. Then we start after 15 minutes. Okay.
জি
Okay,
স্যার,
Okay, sir.
Thank you.
ওয়েলকাম।
Hello.
আসসালামু আলাইকুম স্যার।
হ্যাঁ স্যার,
Assalam.
নমস্কার।
Namaskar. Can we start now?
জি স্যার।
ওকে স্যার।
Okay. Any problem with my communication?
নো স্যার।
What I say, do you understand well?
জি স্যার, বুঝতেছি স্যার।
Okay.
স্যার বুঝতেছি।
Thank you. Thank you. So far we have discussed some of the principles, etc. And then now we will go for, nature of direct taxes. So direct taxes, what I mean by that? Direct tax, as we mentioned to you, income tax is the best example of a direct tax. But what should be the nature of the income tax? We mentioned about the equality of sacrifice theory. It means that everybody has to pay taxes on the basis of their income, but the rate should be different because it depends on the quantum of income. I am earning 5 lakhs taka, you are earning 10 lakhs taka, so you will pay taxes more than what I am paying actually on my income. So that's why it could be proportional, it could be progressive, or it could be regressive. So there are 3 types of direct taxes. That is, it depends on the rate, or it depends on how you pay taxes on your income. Could be proportional, could be progressive, could be regressive. So you have to understand what type of tax is being paid by the people in Bangladesh, or what type of tax is being imposed by the government of Bangladesh. So if you look at the income tax of individuals, let us go to the individuals first, because the rate of tax for the companies or corporations, or for AOP, that means Association of Persons, would be different. So let us first go to individual taxes. So in theory, we can say that the income tax could be progressive. Progressive means the rate of taxes would be different for the quantum of income. Say, if we say that if you earn 50 taka, you have to pay taxes at the rate of 10%. If you earn 500 taka, you will pay at the rate of 15% as tax. If you earn 1 lakh taka, you will pay taxes at the rate of 20% of your income. So it is different, and it is increasing. So when income increases and the rate increases, it will be a progressive taxation. So what would be the system? What is the system that is pursued in Bangladesh, or that is being followed in Bangladesh? So if you see the individual's taxation in Bangladesh, it is progressive up to a certain limit. And afterwards, it becomes proportional. I have given you an example that is, in a table, I have mentioned the rates of taxes. There are different slabs. You see, the slab, there are 6 slabs here. The first slab is up to taka 3 lakh. The percentage of tax is 0. So what is it called? It is called the general exemption limit. I told you before. What would be the general exemption limit? If somebody asks you, what is the general exemption limit in Bangladesh in case of individuals? You have to say that taka 3 lakh is the general exemption limit. That means taka 3 lakh means up to taka 3 lakh. So if you earn up to taka 3 lakh, you don't have to pay taxes. It means that it is the general exemption limit, and the percentage of tax on that income is actually 0. Next, 1 lakh taka. that after 3 lakh taka, if you earn 1 lakh taka per year, then your tax would be 5%. That is the calculation, how you reach at the tax you have to pay. So up to 3 lakh taka, 0, then up to 1 lakh taka, after that, you have to pay taxes at the rate of 5%. It means that you have to pay 5,000 taka as tax on the rest of 1 lakh taka. If you have 4 lakh taka of income, so your tax would be 5,000 taka. Then next slab is 3 lakh taka. When you pay taxes on 1 lakh taka at the rate of 5%, and afterwards, if you have income, and if the income is up to 3 lakh taka, you have to pay taxes at the rate of 10%. That means on that 3 lakh taka, you have to pay taxes 30,000. So if you have income of taka 7 lakh, then your tax would be 35,000. Okay. Next, come to the slab that is up to 4 lakh taka next. That means when you have paid taxes on your 7 lakh taka and you have more income, that is, you have income of taka 4 lakh afterwards, then you have to pay taxes at the rate of 15% on that 4 lakh taka. On that 4 lakh taka means on the amount up to taka 4 lakh. That means if your income is 11 lakh taka per year, then you have already paid taxes 35,000 and up to on 7 lakh taka, and now the rest of 4 lakh taka you have to pay taxes at the rate of 15%. That means on 4 lakh taka your tax will be 60,000. So your total tax would be 60,000 plus 35,000. That means 95,000 on 11 lakh taka. Okay. Then come to the next slab, which is the 5th slab. In this slab, it is said that if you have income more than 11 lakh taka, up to 5 lakh taka, you have to pay taxes at the rate of 20%. That means up to 11 lakh taka, you have paid taxes 95,000. Now on the 4 lakh taka, 5 lakh taka, you are paying taxes at the rate of 20%, which is 1 lakh taka. So it means that before you have paid 95,000 taka, now you are paying 1 lakh taka. So it means that you are paying 1,95,000 taka on your income at 16 lakh taka. And then if you have more income than that is, if you have income more than 16 lakh taka, then you have to pay taxes on the rest amount at the rate of 25%. It means that there is no slab later on, only one slab. It is 25% on the income above 16 lakh taka. So up to 16 lakh taka, the tax is progressive. The tax is progressive, or the tax is of progressive nature, we can better say. And after that, your tax is proportional. That means whatever you earn, if it is 20 lakhs taka, after 16 lakhs taka, whatever you earn, if it is 10 lakh taka, if it is 15 lakh taka, if it is 50 lakhs taka, no question. The tax rate would be 25%, whatever you earn. If you earn 20 lakhs, then tax would be at the rate of 25%. It means that you have to pay taxes at 5 lakhs taka for that 25%. So I can say that the nature of taxation in Bangladesh is both progressive and proportional. Up to a certain amount of money, it's progressive, and after that, it is proportional. Okay, then it is easily understandable to you, I believe. But if I say regressive taxation, the regressive taxation means that as the income increases, rate of tax will decrease. That means If your income is 10 lakh taka and if the rate of tax is 20%, but if your income is say 30 lakh taka and if the rate of tax is 10% or 15%, then it is called regressive taxation. That means as your income increases, your rate of taxation will decrease. So that's the principle. But in one sense, we can say that here in this system, as we are saying that it is progressive to some extent, but it is proportional also to some extent, we can better say whichever portion is proportional, it is in one sense regressive. That means regressive. Why? Because after 16 lakhs taka, you are paying taxes at the rate of 25%, irrespective of your quantum of income. It means that if you have 1 crore of taka income, you are also paying 25%. If your income after 16 lakhs is 20 lakhs taka, you are also paying at the rate of 25%. In one sense, it is regressive. But generally speaking, this is proportional. I believe this is understandable to you. But, the taxes on companies, corporations, Hindu undivided families, AOP, etc., there might be different. Say in case of a company, the tax rate is same, whatever income you earn. That means whatever income the company earns, the rate of tax will be same. So if you earn 1 taka, you have to pay taxes at 40%. If it is 40%, if it is 45%, then 45 paisa, etc. So that is different, and we will be learning those later on. Now, there is an important aspect to learn in order to be a tax expert, because you have to advise the companies, you have to advise the individuals who are willing to pay taxes and who have come to you as a chartered accountant, who have come to you for your advice. And you, as a chartered accountant, will advise him appropriately or properly so that he does not have any difficulty in his assessment to be made by the Deputy Commissioner of Taxes. Or you have to advise the company where you are working in. So the same thing, you have to advise appropriately. And appropriately, you have to advise because of the reason that if you evade tax, you cannot say anything in violation of the taxation principles or taxation policies or taxation procedures. Because if you violate the rules and regulations, you will be penalized, or your company or your concern will be liable to pay taxes with penalty. So that's why you have to learn the taxation law very well so that you can advise the concerned person or concerned company appropriately so that they are not being encountered with any problem. So that's why I am saying that you must know something else before entering deep into the income tax law. Okay, then first of all, we'll be learning, capital expenditure versus revenue expenditure. This is very essential for income tax because there are two types of expenditures, as you know, since you are coming from the, commerce field. So you must have learned the concept of revenue expenditure and capital expenditure, revenue receipt and capital receipt, etc. Why? Because capital expenditure is also incurred by the company and revenue expenditure is also incurred by the company. But you must make a distinction between the two because of some reasons. Why? You understand very well that it is because of the nature of the transaction and it is because of the period of utility for the expenditure. So period of utility, it means that if you buy something which is of a small amount, it might be utilized during the accounting year. Say, for example, some stationery items. So stationery items, definitely it's a revenue expenditure. So the utility of the stationery items would be adjusted within the accounting year. But if you purchase a machinery, definitely it will be a capital expenditure of the concern or for the company. And the utility of the machinery will not adjust or will not be away within the accounting year. It will actually last for a number of years. That means the longevity of the machinery would be for a number of years. That's why you are charging depreciation on the price of the machinery. So, for example, the age of the machinery would be determined at 5 years. If it is for 5 years, then you are charging 20% depreciation against the revenue. That is against the gross profit in the profit and loss account. So that's why it's a capital expenditure, since its utility will be spread over a period of 5 years. So there should be a distinction, and you have to understand why the revenue expenditures are in the profit and loss account and why the capital expenditures are not charged in the profit and loss account. And that's why we have to learn the differences between the two. And the differences between capital expenditure and revenue expenditure include whether the purchases will be used over the long term or short term. So you have to understand whether the purchases will be used for long term or short term. So as I told you before, that the capital expenditure, you can say CapEx, are funds used by a company to acquire, upgrade, and maintain physical assets, such as property, buildings, and equipment. So here, you have to understand, you know already, I believe, because you are all commerce graduates. So that's why you understand them. So property, when we purchase the property, definitely initial expenditure is made. The initial expenditure is definitely a capital expenditure. But whenever repair is made to the machinery, whenever a repair is made to the building or equipment, then what happens? There are spare parts of the machineries. Spare parts are actually bought maybe from the market or from other countries where from the machinery was bought initially. So when the spare parts are coming into the country and added to the machinery, then the price of the spare parts, etc., which are included in the machinery, definitely would constitute the capital expenditure of the machinery. That means it would also be treated as a capital expenditure, not a revenue expenditure. So when you buy spare parts and add them to the machinery you have already bought, it will be added to the cost of the machinery. And the price of the machinery would increase and depreciation would also be increased. So you have to remember that. And you have to distinguish between the capital expenditures and revenue expenditures while calculating the net profit of the company. So that kind of knowledge you must have. Okay. And you can also say that capital expenditures are typically one-time large purchases of fixed assets. So you understand that the capital expenditures are fixed assets. These are not actually current assets. So you can distinguish between the current assets and the fixed assets. What are the current assets? What are the fixed assets? What are the liquid assets, etc.? You must have learned those by this time. So these will be used for revenue generation. The capital expenditures are actually used for revenue generation. That is also a very, very important point you must remember over a longer period. And revenue expenditures are typically referred to as ongoing operating expenditures. These are basically operating expenditures in order to run the business, operating expenditure. And there are, of course, operating income and non-operating income. You know, what are operating incomes and what are non-operating incomes, you must know. And definitely, I am not going to that direction now. Later on, maybe while we will be discussing income tax later on in depth, then we will be going for that. So very simply, we understand that operating income would be the income for which the business is being run. That means the objective of the business, the mission of the business. That means if you are doing business in purchase and sale of trading goods, that is trading business, it is your operating income. Whatever you are earning from that business, it will be your operating income. But if you have some other incomes, those will be non-operating incomes, meaning that if you have deposited some money into the bank, that means you have put it in the FDR. So whatever you are earning from the FDR, apart from your business, that income from the FDR will be treated as non-operating income of the business. So there will be two systems of showing income generation from the business. One would be operating income, another would be non-operating income. So your earning per share calculation, etc., what would be your income from your business, it should be shown separately. That is what you are earning from your main business. It is a matter of consideration. And whatever you are earning from your non-operating sector, that is also a matter of consideration. So that is for another analysis. So I am not going for that now, but later on you will be able to understand. Okay, then what we have learned is that capital expenditures are funds used by a company to acquire, upgrade, or maintain physical assets, such as equipments. Then capital expenditures are typically one-time large purchases of fixed assets that will be used for revenue generation over a longer period. Then another point is that revenue expenditures are the ongoing operating expenses. So you must remember that these are ongoing operating expenses, which are short-term expenses used to run the daily business operations. Sometimes with regard to revenue expenditures, you can say that the stationery, what we buy for the business, may not be used during the period. So that's why what we do, we make a provision for deferred revenue expenditure. It means that the stationery which is not being used in the business for that accounting period is actually carried over to another period, and which would be treated as deferred revenue expenditure. Now, revenue expenditures we mentioned, but still a little bit more discussion could be made on that. Revenue expenditures are short-term expenses used in the current period or typically within 1 year. It means that within 1 year, you have to use all those expenditures. Revenue expenditures include the expenses required to meet the ongoing operational costs of running a business. And those are essentially the same as operating expenses. You can better say wages, salaries, stationery items, rent, rates, taxes, etc. All these are actually revenue expenditures. Revenue expenditures also include the ordinary repairs and maintenance costs that are necessary to keep an asset in working order. I told you before that the repair to the machinery will be treated as capital expenditure, but here we are also saying that ordinary repairs for maintenance, those are actually revenue expenditures. Why? Because in order to keep an asset in working order without substantially improving or extending the useful life of the asset. So these are for substantially improving or extending the useful life asset. These are not for. These are just for keeping them in working condition. So that's the case. So when you decide, when as a chartered accountant, you will be advising a company that this expenditure, whether will be treated as a capital expenditure or revenue expenditure, you have to know that for tax purposes, this is capital expenditure, this is revenue expenditure. You have to advise the owner of the company or owner of the concern. If he says that, okay, I have incurred an expenditure for repairs, you must keep it or you must treat it as a capital expenditure. But if you see that this is not for making the machinery operable for over a number of years, then why should you go for it? You should not go for it. It is just to keep the condition of the machinery or other equipments workable. So in that case, it is, revenue expenditure. Revenue expenses related to existing assets include repairs and regular maintenance, as well as repainting and renewal expenses. Revenue expenditures can be considered to be recurring expenses in contrast to the one-off nature of most capital expenditures. Now, just for painting or, painting of the chair, painting of the table, etc. So general repair. So it is meaning that actually. What types of revenue expenditures are there? So you must know what type of revenue expenditures are there. I mentioned to you a little bit, and now you can say that salaries and employees' wages, etc. This is of course revenue expenditure. Any overhead expense, such as salaries for the corporate office, which typically fall under selling, general, and administrative expenses. So if there is a selling expense, general expense, or administrative expense, of course, all these are revenue expenditures. Research and development, this is also revenue expenditure. But if you buy something, copyright, or if you have to pay royalty, etc., if you buy that, in that case, it could be capital expenditure, not revenue expenditure. Utilities and rent, of course, electricity, water, and rent, etc. All these are revenue expenditures. Then business travel. Business travel means if you travel to other countries, of course, in order to find out market for your product, definitely that would be treated as a revenue expenditure, because if you send your manager to another country in order to explore the market for that product, or in order to talk to some of the importers in that country, you have to incur expenses with regard to his expenditure, because he has to go there and pay money for your air travel. He has to stay in the hotel, etc. So that's why all these expenditures related to his travel to that country would be treated as revenue expenditure. Then property taxes. Of course, if you have to pay taxes on your property, definitely you have to treat them as revenue expenditure, because there could be taxes on your building, there could be taxes on your other properties, etc., related to the business. And you know that the treatment of the revenue expenditure, how it is done in the accounting of the business. Revenue expenditures or operating expenses. So when you are saying revenue expenditure, it's actually operating expenses, which are actually recorded on the income statement. If you say income statement, it is the profit and loss account, trading account, etc. So there are different, vocabularies. So you can treat any one of them, or you can consider any one of them. These expenses are actually subtracted from the revenue that a company generates from sales to eventually arrive at the net profit or net income for the period. So you understand that income statement could be prepared in one format, or if you do it in the trading account and profit and loss account form, you can also do it in the same way. But the general principle is that all the revenue expenditures would be subtracted from the gross profit, and you have to arrive at the net profit. So net profit will be the basis on which the tax will be imposed. Okay. Then capital expenditures, the accounting treatment, how would it be? Capital expenditures represent significant investments of capital that a company makes to maintain, or more often to expand its business or generate additional profits. So I have already explained it to you. Capital expenditures consist of the purchase of long-term assets, which are assets that last for more than 1 year, but typically have a useful life of many years. Maybe it is for 5 years, 10 years, 20 years even. When there is a building, it will last for 20 years. It will last for 50 years even. So that is capital expenditure, and its useful life is over a period of 50 years, 60 years, 80 years, whatever it is. Capital expenditures are often used for buying fixed assets. Generally, these are used for buying fixed assets, which are physical assets such as equipment. So generally, these are for fixed assets, and especially to mention that these are equipments or machineries, etc. As a result, capital expenditures are typically for larger amounts than revenue expenditures. However, there are exceptions when large asset purchases are consumed in the short term or the current accounting period. That is, of course, different, but you can say that if we buy physical assets, generally, equipments and plants, machinery, etc., those are of physical nature. But there are some other assets. Maybe if we buy goodwill, then what happens? If we buy goodwill, it is also fixed asset. We say intangible asset, but this is fixed asset in the sense that it will last over a period of time. It is not for 1 year. If we buy copyright, if we buy know-how, definitely we can use the patent of the company, another company of another country. That is also not for 1 year. That is also for over a number of years, maybe for 20 years. I have been granted a royalty with which I can manufacture the medicine in Bangladesh. But that is an American company. It has granted me royalty, and we are paying royalty to the company. If I pay that amount one time, maybe at a time, it will be treated as a capital expenditure. But if I pay it every year, as per the terms and agreements with that company, that would be revenue expenditure. So you have to treat it in that way, and it will depend on your common sense and understanding and expertise. Then we go for types of capital expenditure. What types of capital expenditures are there, or CapExes are there? Capital expenditures can include the purchase of the following. That means I have mentioned in the handout that a facility or factory, including an upgrade or expansion. So facility means I can buy something, say building, say premises, etc. There is a facility. And factory is also a facility, of course. If I upgrade it, that is also included as a facility to the existing facility. And expansion, there is also a new facility to the existing facility. So that's why all these are actually capital expenditures. Vehicle, such as trucks used for the delivery of product, say for example, motor cars, motor vehicles, trucks, lorries, van, etc. All these are actually used for transporting employees or transporting goods, services, etc. So these are actually capital expenditure. Manufacturing equipment, capital expenditure. Computers, capital expenditure. Furniture, capital expenditure. So these are the different types of capital expenditures. Capital expenditures are often used to undertake new projects or investments by a company. New projects could also be treated as capital expenditure. Of course, you would have an extension of the business. There would be an extended facility of the factory. All these are actually capital expenditures. The purpose of CapEx is to expand a company's ability to generate revenue and earnings. So, of course, if there is a new facility or expansion of the business would be able to produce more products. And if it produces more products or manufactures more products, it means that it could be able to sell the products in the domestic market as well as it can export to the other countries of the world. So the more the export, the more the remittance, and the more the earning of the company, and more the taxes of the government. Okay. Then conversely, revenue expenditures are the operational expenditures for running the day-to-day business and the maintenance costs that are necessary to keep the asset in working condition. So it is generally to keep the working condition of the assets, which are actually called revenue expenditures. Companies often use debt financing or equity financing to cover the substantial costs involved in acquiring major assets for expanding their business. So how to acquire the major assets for expanding the business? You can do it in two ways. Number one is that if you have equity capital, you can utilize the equity capital in order to acquire the asset, or you can go for debt financing. It means that you can take loan from the bank in order to acquire the asset or in order to purchase the asset. So there are two ways actually. But the difference is that if you go for debt financing, you have to pay interest to the bank. That is an extra expenditure you have to incur. So if you buy the asset with your debt money, you have to pay interest, and that interest will be charged against the profit. It means that your net profit will be reduced. Compared to a company which will be buying the same machinery with its equity capital, it means that that company would not have to pay interest to a particular financial institution. So that company's profit will be more than the another company's. So there is a difference between the two. Now we have to advise the company which way it should go, whether it would go for debt financing or whether it would go for equity capital. That means utilizing equity capital or not. As a chartered accountant, this is your duty to advise the concern or the company which way it should go, what would be beneficial for that company. So you have to prepare yourself from now on that the analytical power of a chartered accountant should be there. If you understand everything well, definitely you can advise the company properly. If you do not understand well, then you cannot advise the company in the appropriate manner. So if you say that there is unutilized equity capital in the company, which is not utilized, in that case, you can advise the company that you go for purchasing the asset or equipment with your equity, not with the debt capital. But if you find that equity capital is not in the business, is not available, in that case, you can go for debt financing. But you should make an analysis whether after meeting the interest charges, whether the company would be competitive, whether the company would be able to make a profit. So for example, if you have to pay 9% interest, one digit, I should say, After settling the interest at the rate of 9% on the debt capital, the net profit would be how much, and whether it still can make money, still can make profit compared to its competitors. So that is a major question you have to face. I am just giving you hints what you have to do in future. So from the very beginning of your career, you have to develop that analytical skills, analysis, how the company should go for in terms of the project. What would be the sensitivity analysis? You can make a project viable, but considering some of the criteria. That means what would be the net present value of the project? The project will run for 20 years or 30 years. And what would be the net present value now? So if the net present value is positive or it's substantial in figure, then you can advise the company that you can go for this project. But if you find that it is not positive, it is negative, then you will advise the company not to go for that project. But still then you need to have a sensitivity analysis. And there are some also factors, social factors you have to take into account. What would be the environmental impact? So if there is an environmental impact on the production, you can also consider that, whether the company would go for that or not, or should go for that or not. What would be the prospect of the product? Whether there is a market. You have to analyze demand and supply situation. Also consider the number of the competitors in that particular manufacturing sector. So these are the considerations you have to make. And as a chartered accountant, you must know that what are the factors that will impact the manufacture of the product. Okay. I have said in my handout that debt financing can involve borrowing money from a bank or issuing corporate bonds, which are IOUs, to investors who buy them and get paid interest, periodically. Equity financing involves issuing shares of stock or equity to investors to raise funds for expansion and capital improvements. So these are also matters of consideration, whether the company will go for that, whether the company would be able to issue some, bonds or issue some shares, etc., whether the company is listed with the stock exchange or not. If the company is listed with the stock exchange, definitely it can go for issuing, shares. So or bonds, etc. So you have to make an analysis whether it would be profitable for the company or not. What is the earning per share? If the earning per share is good and people have confidence, investors have confidence in the company, they will definitely go for investing in that company. But if the company's earning per share is not good, liquidity position is not good, the liquidity ratio is not good, current ratio is not good, debt equity ratio is not good, then people will not be interested in investing in that company. So you have to know that type of considerations. Then you go for CapEx accounting treatment. The purchases or cash outflows for capital expenditures are shown in the investing section of the cash flow statement. These are generally shown in the cash flow statements. The CFS, that is cash flow statements, are very necessary. It shows all the inflows and outflows of cash in a particular period. So by looking at the cash flow statement, you will be able to understand that how much money you will be needed in liquid form in order to, make cash outflows, and what would be the incoming, inflows, that is flows of cash. When a company buys equipment, for example, they must show the cash outflows on their CFS. In addition, the equipment must also be recorded within total assets on the balance sheet. Yes, these are the basic accounting treatments, you know it very well. So you will be very cautious not to escape all those while making the financial statements or auditing the financial statements. or advising the companies or concerns in terms of, accounting treatments. Since long-term assets provide income-generating value of a company for a period of years, companies are not allowed to deduct the full cost of the asset in the year the expense is incurred. This, I have explained to you. Instead, they must recover the cost through year-by-year depreciation over the useful life of the asset. So this is also been explained by me, and you know that how depreciation is charged. It is a charge. Depreciation is a charge. It is not an expense. You must remember, and this is charged against the revenue. And if I ask you what a depreciation is, definitely depreciation is a charge. It's not an expense. And you can better say, if you understand very well accounting, you will say that this is a conservator of fund. Conservator of fund, sometimes it means that you are creating the fund for replacing the machinery in the near future. Sometimes depreciation is charged against the revenue. Sometimes depreciation fund is created. When depreciation fund is created, it means that the money will go to that fund. You cannot actually withdraw the fund for other reasons. It is specifically meant for replacing or replacement of the machinery. So whatever you are charging as depreciation, it means that you are putting it into the fund, because that amount will be utilized in the future for purchasing the similar machinery or same machinery, whatever it is. Okay. In other words, the cost of capital expenditure is spread over many periods or years, whereas revenue expenditures are expensed in the current year. I mentioned it to you later on. Okay, I'm not going in details of that. Okay, now we have covered up to capital expenditure and revenue expenditure. Now, a small point is that there should be capital receipt and there should be revenue receipt. So you understand from this. What is a capital receipt? Capital receipt is that you are getting an income which is not from revenue operations. So it means that when you have capital receipt, it is not to be taxed. So tax is actually imposed on the revenue receipts. So that is to be remembered by you very well. Okay. So when there is a capital receipt by the company, tax should not be imposed on that, and you should not show it as an income from the operation. Say, for example, if there are shares of the company, that means if the company buys shares of other companies, and if it can make some capital gain out of that, it is a capital receipt. It is not a revenue receipt. And if it is a capital receipt, in that case, tax should not be imposed on that until and otherwise specified. It is specifically mentioned in the income tax ordinance. So if it is mentioned in the income tax ordinance that capital gains has to be taxed, then it will be taxed. Otherwise, it will not be taxed. Say, for example, in case of an individual, that means you are working with a company, you are getting salary from that company. So you are having your salary or wages, whatever it is. But when you retire, you are getting a benefit, which is called lump grant. So it's a lump grant, or you can have just a particular fund, one-time fund from the company. So if you receive like that, that will be treated as a capital receipt, not a revenue receipt. So if it is a capital receipt, it will not be taxed. You don't have to pay taxes on that, but you have paid taxes actually on the salaries, emoluments, etc. So on the pension money, yes, it is exempted from tax because it is actually exempted as per government order, as per SRO, or as per Income Tax Act or Income Tax Ordinance, whatever it is. But the receipt from pension savings certificate, if you buy as a pensioner pension savings certificate, that pension savings certificate will yield you some money, that is interest. So that is not actually exempted from tax. But yes, a portion of it is exempted. It is up to a certain amount of money. If that amount is up to a certain amount of money, that investment, that means if you buy pension savings certificate for an amount of up to taka 5 lakhs and the interest accrued on that would be exempted from tax. But if you buy pension savings certificate for an amount of taka 50 lakhs or an amount above 5 lakhs, then that amount means interest on that amount would not be exempted from tax. So it means that it is taxable. It is not capital receipt. So it is a revenue receipt and it will be taxed. So like that. So the difference is there. So what we have covered is that we have covered good taxation system, features of a good taxation system, a little bit public finance, of course, and we understand how it was introduced. And later on, we have covered capital expenditure, revenue expenditure, capital receipt, revenue receipt, etc. And we have also covered the types of taxes, etc. What types of taxes are available in Bangladesh, and direct tax, indirect tax, and the nature of taxes, the procedure of calculation of taxes, and the nature of progressive taxes, regressive taxes, proportional taxes, what types of taxes are available. And we have given you some of the calculations, that means the rates applicable to an individual in this current assessment year. So all these are actually needed for you in order to appear at the examination. I am not sure when you will be appearing at the examination, but whenever you appear at the examination, all these are actually very much basic things you have to understand, you have to know. So far, it is okay for you or not? Can you hear me?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Is it understandable?
Yes, sir.
Okay. Now we will be moving to Income Tax Ordinance 1984. So I have written in my handout that you have to go through some of the points here of the Income Tax Ordinance 1984 as amended up to 30th June 2020. Do you have that book, Income Tax Ordinance? Have you collected it or not?
So collect kursi আমরা, sir. We collected it.
Okay. You haven't, if you haven't collected it, you please collect it immediately, because this will be needed for you. It is needed for everyday use actually. So Income Tax Ordinance 1984 as amended up to 30th June 2020. So this is needed for you. And first of all, before going into details of the Income Tax Ordinance, let us discuss a little bit on the tax system. When the tax system was introduced in the world, you have an idea about that? The tax system was introduced around 3000 BC, before Christ. That means it is 2020, it is AD, it is not BC. So around 3000 BC, it was introduced in Egypt first by the pharaohs. So tax was there. So it's very old, and it has been mentioned in the Bible that tax was introduced in Egypt. Okay, so many countries actually followed that system. Different types of taxes were there. Sometimes it was on head count basis. That means if you have 5 people in your family, you have to pay taxes at 50 taka. So for example, it's an example. So this type of tax was also available someday. But as time passed, the system was actually improved and the system was modern. So in Bangladesh, we have inherited the system from the British because we inherited Income Tax Act 1922. Before that, there was also Income Tax Act, but actually Income Tax Act, which we followed, that was basically the Income Tax Act of 1922. And even after independence of Bangladesh, that was followed by us. But there were amendments every year through Finance Act. Finance Act was, enacted every year, and there is a chapter on income tax in the Finance Order or Finance Act. So that is related to the income tax and customs, VAT, etc., because there were necessary amendments to the Income Tax Ordinance. So in 1984, the Income Tax Act 1922 was amended. It means that it was an ordinance, not an act. Why? It became an ordinance rather than an act. And why it was like that? Do you have an idea? As a chartered accountant, you must remember that why it was an ordinance, why it was not an act, although earlier it was an act. Any idea about that? As a chartered accountant, you must know it, because that time there was no parliament in session. It was 1984 when President Ershad was in power, and he did not have, parliament that time. So it was placed before the president, and the president assented to the bill, and he signed it. So that's why it became an ordinance. So it was not an act. Had it been passed in the parliament, it would have been an act. Okay. So let us go to Section 2 of Income Tax Ordinance. What is said in Section 2 in Income Tax Ordinance? Have you gone through that? I gave you some hints what you will learn. So you have to know about some definitions. First of all, you have to know agricultural income. So what does it mean, agricultural income? So in very short, we'll be analyzing that income later on, because each and every income has got its details. So there are different sections of the Income Tax Ordinance. In Section 26, you will find agricultural income, how to calculate the agricultural income in order to impose taxes on that. So generally speaking, agricultural income is that when you are growing crops and you are selling the product, on the sale proceeds, definitely you have to pay taxes. This is an income. Okay. So you will read in detail what is there in the agricultural income. Tea is also an agricultural income and partly an industrial income, but that has been mentioned here. If you have agricultural farm in a particular area, say for example, you have 20 bighas of land on which you are growing crops, different types of crops. So definitely the income from the crops would be treated as agricultural income. But if you have a building there and you are renting out to some people and you are earning rental income from the people, so that income from the building, since it is located in the agricultural farm, it will be treated as an agricultural income as well. So that's the tricky point you must remember. So in the agricultural income, what does it cover? You must know. So I am giving you in short now, because when we will be discussing section 26, we will be discussing in detail. So you must have an idea. What I am saying now, you must have an idea, and you try to consume the definition. Amalgamation, another term is that. It is in alphabetical order. Amalgamation, I am not going for that now, because amalgamation is a different thing when two companies are merged together. Amalgamation, absorption, reconstruction, etc. You have gone through those in the accounting. So while you studied accounting, you must have learned that. So I am not going in detail of amalgamation. This is not very necessary now. So when it will be necessary for me to make you understand or for you to learn more, in that case, we will be discussing. Number 3, annual value. Annual value, it's a very important term for you. You must learn it, what annual value is, why it is needed. So first of all, why it is needed. We will also be learning it in detail when we will be discussing section 24. So you must know section 24. It means that section actually deals with house property income. So in order to calculate the house property income, you must know the annual value of the property, annual value of the residential building, annual value of the residential house, like that, annual value of the apartment you are living in. So this is very necessary, because as a chartered accountant, you must know the difference between the annual value and the rental value of the property. So you can say that, okay, since I am renting out my property, renting out my apartment or my building or my house to a particular person, I am getting the rent from him. So on the rent, I have to pay taxes. That might be a general conception, but it is not always true, because income tax says differently. So you must know the difference between the annual value and the rental value. Annual value and rental value are different. Annual value may be different from the rental value, because rental value is what you are getting as rent. But annual value is the price or the sum for which the property might reasonably be expected to let from year to year. It means that it will be decided by the Deputy Commissioner of Taxes. If you say that I have received 1 lakh taka as rental value of the property per month, so my annual rental value is 12 lakh taka. So I would like to pay taxes on that 12 lakh taka. It may not be accepted by the Deputy Commissioner of Taxes. He might say that I believe that your rental value is less than the annual value of the property. So the annual value is, as I have said to you now, the sum for which the property might reasonably, you have to remember these two words, be expected to let from year to year. So it should be reasonably let. If it is 1 lakh taka per month, if you say, and if the DCT thinks that it is not 1 lakh taka, it is 1,20,000 taka or 1,50,000 taka, then he thinks that it might reasonably be expected to let at 1,50,000 taka per month. It means that, in his opinion, the annual value of the property would be 18 lakh taka, not 12 lakh taka, as you have shown in your return. And on the basis of the annual value of the property, he will calculate the income from the house property on which he will be imposing taxes. This is the idea of annual value. But the situation may be reversed. When you say, or when the DCT thinks that the annual value of the property is less than the rental value, the annual value of the property would be rental value then. It means that you have shown the rental value at taka 12 lakh per year, but the DCT thinks that the annual value of the property should be 10 lakh taka per year. If he thinks so, then he will treat your rental value as the annual value of the property. So on the basis of the value you have shown, that will be treated as the annual value and tax will be imposed on that. So this is in relation to a property actually. It might be a residential property, it might be a commercial property. Both cases, it will be annual value. Okay, this is very important for you to remember. You must know it. You have to learn how to write about the annual value of the property, and questions often set with regard to the annual value of the property. Okay, then another definition is there, appellate joint commissioner. So appellate joint commissioner, who he is, you must learn that. Appellate joint commissioner, it is a post, of course, in the middle of the zone. So we'll be discussing in details later on, but for your understanding, I have to say that joint commissioner is a person who is appointed to be a joint commissioner of taxes as per Income Tax Ordinance 1984. It means that the starting point in the income tax department is that the class 1 officer is an assistant commissioner of taxes first. So he is recruited by the PSC, Public Service Commission, as per requisition given by the National Board of Revenue, that is the IRD, Internal Resources Division. You must remember one thing, because in order to practice income tax or in order to advise your concern or company, you must know the structure of income tax first. The field administration of the income tax is administered by the National Board of Revenue. National Board of Revenue is the regulating body. It is under the Internal Resources Division of the country. Internal Resources Division is under the Ministry of Finance. So Ministry of Finance has different divisions, like Finance Division, like Financial Institutions Division, and Internal Resources Division, then Economic Relations Division, etc. So these are the divisions under the Ministry of Finance. So in the Ministry of Finance, the IRD is one of the divisions, and the Secretary IRD, that means in charge of the division, the person who is top of the position is the secretary. Secretary is in charge of the division. So the secretary in charge of the IRD, that means Internal Resources Division, would be the chairman of the National Board of Revenue. He is called ex officio chairman of the National Board of Revenue. Ex officio chairman means that by dint of his position as the secretary of the Internal Resources Division. So under the National Board of Revenue, there are commissioners. So commissioners are in charge of zones. So many zones are there, as good as 40 zones are there in Bangladesh in the income tax department. So a zonal chief would be the commissioner. Under him, there will be an additional commissioner of taxes. Under him, sorry? Yes, any problem? So under the commissioner of taxes, there would be additional commissioners and there would be joint commissioners. So joint commissioners and additional commissioners, there is not much difference between the two. The joint commissioner is not under the additional commissioner. Additional commissioner and joint commissioners are under the commissioner of taxes. So both of them, that is the additional commissioner and joint commissioners, they are supervising the works of the deputy commissioners of taxes. Not only deputy commissioner of taxes, they are also supervising the works of the assistant commissioner of taxes, who are responsible for assessment of the incomes of the people or companies, etc. So if you are asked a question, who are the assessing officers, you can say that there are three types of officers who are in charge of assessment. The pivotal role is played by the Deputy Commissioner of Taxes. Deputy Commissioner of Taxes, then Assistant Commissioner of Taxes. They are performing the same functions. There is another type of officer which is called Extra Assistant Commissioner of Taxes. They are also assessing the incomes of the companies or individuals. So the difference is, I told you before that an assistant commissioner of taxes is the, class 1 officer. That is the first ranking class 1 officer. So they are entering into the department through recruitment by the PSC. And the extra assistant commissioner of taxes is another type of officer who is also responsible for making assessments, but they are not class 1 officers. They are promoted officers. That is, they are promoted from within the department. That means from the position of an inspector, they get promoted to the rank of an extra assistant commissioner of taxes. So you must remember one thing, the DCT, that is the Deputy Commissioner of Taxes. What do you mean by DCT? If you ask a question, or if you are asked a question, who is a DCT, you must say that our DCT or our Deputy Commissioner of Taxes includes a Deputy Commissioner of Taxes, an Assistant Commissioner of Taxes, and an Extra Assistant Commissioner of Taxes. So all these three types of officers are called Deputy Commissioner of Taxes. So when an assessment is made and signed, an assessment order is signed by the Deputy Commissioner of Taxes, it means that he might not be Deputy Commissioner of Taxes. He might be an Assistant Commissioner of Taxes, or he might be an Extra Assistant Commissioner of Taxes, but as per law, he can write it. So this is for your understanding, you must remember that. So Joint Commissioner of Taxes, as I told you before, he is above the position of the Deputy Commissioner of Taxes, and he supervises the works of the Deputy Commissioner of Taxes. But he is responsible to the Commissioner of Taxes, not to the Additional Commissioner of Taxes, because the Additional Commissioner of Taxes and the Joint Commissioner of Taxes are working similarly, and their functions and responsibilities are the same. So that's why there is a difference. Only difference is in terms of scale. The Additional Commissioner of Taxes is getting a higher scale, and the Joint Commissioner of Taxes is getting a lower scale. This is the difference in the scale. So Appellate Joint Commissioner of Taxes, little bit different, his function, because he is not supervising the Deputy Commissioners of Taxes or Assistant Commissioner of Taxes. Rather, his function is in relation to hearing of appeals. Hearing of appeals, when does it come? Appeal hearing, you might have heard it. So it is in relation to the assessment. Assessment means the assessment is made by the Deputy Commissioner of Taxes or the Assistant Commissioner of Taxes, but the person concerned, that is the assessee or the taxpayer, may not be satisfied with the assessment order. That means the businessman who is thinking that his income is 5 lakhs taka, but the income has been estimated at taka 6 lakhs or 7 lakhs or 8 lakhs, whatever it is, for which he is not satisfied with the action of the Deputy Commissioner of Taxes. So that's why he is aggrieved. And in order to redress his grief or his aggrievedness, he can make an appeal to the Joint Commissioner of Taxes. And that Joint Commissioner of Taxes would be Appellate Joint Commissioner of Taxes. So against the Deputy Commissioner of Taxes, the person concerned would be able to make an appeal, or prefer an appeal. I should say prefer an appeal. And the Joint Commissioner of Taxes would be hearing his appeal. Would be hearing his appeal means you can place the arguments. Those are valid for the SSC, and under which the Joint Commissioner should redress the grievances. And the appellate Joint Commissioner, after hearing the appeal, he will make a decision whether the action of the DCT will stand, or the action of the DCT will be revoked, or the action of the DCT will be changed. That means the income which has been arrived at by the DCT is 8 lakh taka in place of the showed income of 5 lakh taka. Now the appellate Joint Commissioner of Taxes can reduce the income to 6 lakh taka, or it could be reduced to 5 lakh taka. Can you mute it? If you talk to each other, then I cannot continue. Okay. Did you hear me well?
Yes, sir.
Yes, sir.
Okay, but if you people talk to each other, there is no point in speaking from my side. Okay. Then let us go to another definition, which is called appellate tribunal. This is also very necessary for you in the sense that the Taxes Appellate Tribunal, you have heard of it. So when you should go to the Taxes Appellate Tribunal? Should I continue or not?
Sure, sir. Please.
Okay, Appellate Tribunal, I am mentioning to you. You must learn about Appellate Tribunal. It means that when the SSC or the taxpayer is not satisfied with the decision of the Appellate Joint Commissioner, as I have mentioned to you before, then where should you go? Then you should go to the Taxes Appellate Tribunal. It means that you have got two options. First, you are going to the Appellate Joint Commissioner. And if the Appellate Joint Commissioner is not give a decision in your favor, and you are not satisfied with the decision given by the Appellate Joint Commissioner, then you go to Appellate Tribunal. So Appellate Tribunal is a higher body. There is a president there and some other members. They will hear your appeals. That is, the decision of the Appellate Joint Commissioner will be reviewed by them. So if they think that the decision fair, that means they will issue an order reflecting their opinion, and they will advise or direct the Deputy Commissioner of Taxes to revise the order accordingly. It means that your grievance will be redressed. That is the highest body you can go to in order to redress your grievance. But there is another option for you, which is that you can go to the High Court if you want to, but you cannot go to High Court for all the reasons. If you are not satisfied with the decision of the tribunal, you can go to the High Court, but there should be a point. Which point is that? If your point is relating to law, if it's a law point, legal point, then you go to the High Court. If it is not a legal point or law point, then you cannot go to the High Court. The tribunal would be the last forum you can go to. So what type of points would be there? It's a factual point. Factual point means your sale was estimated at 8 lakhs taka or 10 lakhs taka in place of your shown sales of taka 5 lakhs. So that is a factual point. So this can be dealt with by the tribunal, not by the High Court. But if there is a point which is relating to law, that is, you are not satisfied with the interpretation of the law point, then you go to the High Court. And if you go to the High Court, then High Court will accept your appeal and they will hear your appeals and then they will give a decision. So that is the highest forum you can go to. Okay, then you see there are some definitions like approved gratuity fund, approved superannuation fund. All these are related to the employees of an organization, how the fund will be created, and the treatment of the funds, etc. First, you go through them, and you are not actually required to study it in details. But when we will be calculating the income of individuals for assessment purposes, then we study them well. If you have any problem with the treatment of the superannuation fund or provident fund, we will be learning those later on, not now. And then, you know, another important definition is SSC. SSC means taxpayer. So who is an SSC or who an SSC is, you must know. You go through it properly. SSC means a person who is paying taxes in general, who is required to submit the return to the income tax authority is called an SSC. Of course, if you have, you know, an income below the general exemption limit or up to the general exemption limit, then you don't have to submit a return to the income tax authority. Then you are not an SSC. But if you submit a return before, and if your income is less than the taxable limit, still then you have to submit a return. And in that case, you are still an SSC. Then if you want to be assessed for any reason, say for example, I want to be assessed for some reasons or other. Say for example, I will submit an application to the Rajuk, Rajdhani Unnayan Kartripaksh, for having a plot or for acquiring a plot. And in that case, I need to submit a TIN. So if I have a TIN and if I want to be, you know, assessed by the income tax authority, then of course I will be an SSC. And then every person who is deemed to be an SSC or an SSC in default under any provision of this ordinance. So for example, a person who was supposed to pay taxes in the earlier years and he has not paid the taxes, or he has escaped the payment of the taxes, or who was penalized but he did not pay the penalty. So if you haven't paid the penalty before, which you are supposed to pay, you are still an SSC under the income tax ordinance. So the definition actually involves a lot of concept is not. So that's why this is very important. Go through it. And then you come to the assessment, what is called assessment. You also know what is an assessment in general, maybe. When income is assessed by the Deputy Commissioner of Taxes for imposing taxes, it is called assessment. The assessment, in the assessment procedure, there are a lot of formalities to be completed. I am not going in details, but you must remember that assessment is, making the income taxable, or imposition of income on the imposition of taxes on the income of a particular person, etc. And the procedure is called assessment. Then,
হ্যালো স্যার শুনতে পাচ্ছেন?
yes,
আমাদের 6:30
Hello.
আবার ক্লাস আছে একটা। আজকে যদি এখানেই
yes, please tell me.
স্যার বলতে চাচ্ছিলাম আমাদের 6:30 ক্লাস আছে স্যার।
Okay, so we finish now. But
স্যার
you
করা যেতে
go
পারে
through the
স্যার।
definition.
স্যার আমরা নেক্সট ক্লাসে পরবর্তী থেকে
Yes, we will start from this point in the next class. But I have given you an indication which you will be studying in the Income Tax Ordinance, especially the definition chapter, and then section 3, 4, 5, 6, something like that. I have noted in the handout, mentioned in the handout. So go through those later on. We will be discussing. Okay.
Okay, sir.
Yes, sir.
Okay. Thank you very much for your attendance.
নমস্কার স্যার, ভালো থাকবেন।
Thank you, sir.
Yes, sir.
Thank you, sir.
Welcome.